The second application that we've identified for MACD crossovers is to confirm the turning points within specific chart reversal patterns. So not only the turning point that starts the pattern, but each of the different up and down points throughout the course of the pattern unfolding. For example, in the case of a 1, 2, 3 top, this little illustration shows in the number 1 position you will have a bearish MACD crossover. In the number 2 position you'll have a bullish MACD crossover. And in the number 3 position you'll have another bearish MACD crossover. Depending on what time frame you're working with, you won't probably see those happening all on the same time frame. But the important point here is that we're always using multiple time frame analysis, drilling down to different levels. So if you don't see that confirming crossover on, say, a daily chart, just drill down further to, say, a 4-hour or 3-hour. Somewhere down the line, you will see a MACD crossover confirming each of the individual turning points within the pattern. Same thing with a double top. Say if you were looking at a daily double top, on a 4-hour chart, you will most definitely see confirming crossovers for each of these turning points within the pattern. Same thing for a triple top or bottom, a declining 3 pyramids type setup, these very simple mushroom top or saucer bottom patterns, or the very famous head and shoulders pattern. Again, you won't necessarily see those events happening all in the same time frame. It's probably highly unlikely in most cases. But drilling down to a lower level time frame, you will always get a crossover event outlining the contours of each of these individual patterns. So let's take a look at a chart example showing that right now. Okay, here is a chart which is going to give us a 1, 2, 3 bottom pattern. And actually I'm going to have to cheat here a little bit just for the sake of getting through Module 2 without going into too many tangents. What we would want to do with this chart, if it was a higher level time frame like a 4-hour or a daily chart, we would want to line it up side by side with a lower level time frame, because what you can see happening here is that we had this very sharp drop in price terminating in this really nice spinning top candle pattern. Signs of some kind of a bullish reversal was given by this MACD crossover. Again, we did the prudent thing, which was to wait for the histogram bar to paint in green on the opposite side of the water line. But as a good trading practice, you probably don't want to just sort of quickly jump into the long side when you've gotten 1 or 2 bullish signals at the end of a sharp drop in price like this. Seems to me from experience that a really strong drop or rise in price is not just going to turn on a dime and go the other way in most cases. In most cases it's going to want to do some kind of a bottoming out process involving a retest of prior lows in this case, which happened over here, before we have a really good strong level of confidence that we've got a bottom hammered out here and price is going to go higher. Now, if we did line this up side by side with a lower level time frame, I absolutely guarantee you that after this number 1 position, we do have the bullish crossover here. We don't have a bearish crossover corresponding to this number 2 position, but the lower level time frame would have given that to us, and we're going to see examples later on of that prove that in spades. But anyway, price, so it came back up to this 100-period moving average, which formed resistance almost to the last pip. And then when we saw price closing back down below, we had pretty good idea that the retest was about to unfold. So price came part of the way down to the old lows, and then we had this very strong bullish close. And then when price closed back above both this number 2 position, which is the high of this interim high candle here, both that and this 100-period moving average, that was a strong bullish kind of breakout signal. So again, we didn't get the crossover confirming the number 2 position or the number 3 position. MACD just sort of kind of dipsy-doodled here before continuing on. But we would have had a bullish crossover here on a lower level time frame as well, a bearish crossover, another bullish crossover, and then again, without delving too much into the entry strategies at this point, we could have either chosen to wait for price to break or close above this 100-period moving average or this number 2 position, or a Tom DeMark style trendline break, which we did not draw in here, any of those three strategies would have given you a good entry signal into this ensuing up move. So in any event, we've got part of the crossover paradigm on this time frame. The number 1 position is outlined by this bullish crossover. It didn't do so on the number 2 or 3, but if we drilled down lower, we would have definitely seen that as a confirming signal around these turnaround points as well. Whenever we see MACD crossovers occurring in conjunction with a reversal candle pattern of some kind, that can also be a helpful confirming or validating signal. And if you're not yet familiar with the major candlestick types, you'll definitely want to go out and get Steve Nissen's excellent book, Japanese Candlestick Charting Techniques. And if you manage to learn by heart half of the reversal candles that he's got cataloged in there, you'll be better off than most people. So we'll just look at just a couple of just representative candle types. But the principle that we're dealing with here is that if we're looking at what we believe to be a bullish reversal candle, a bullish MACD crossover can just simply help confirm that. And similarly, a bearish reversal candle occurring in conjunction with a bearish MACD crossover is just one more piece of the confluence puzzle. So, for example, if we were to see either of these two candles, to the left we have a hammer, which is a reversal if it occurs at the bottom of a down move, and to the right we have a hanging man. Some people call that an inverted hammer. That's confirmed often by a lower close. But if you get either a bullish MACD cross on the candle to the left or a bearish MACD cross on the candle to the right, that just adds more ammunition to your setup. And here are a few more of the more common candle patterns: bullish and bearish engulfing patterns, morning or evening star patterns, and railway tracks, which some people refer to as 2-bar up thrusts. So let's look at a chart example lining up MACD crossovers with reversal candles. Okay, here's an example of how a so-called textbook quality candle reversal pattern occurring in conjunction with a MACD crossover can help you start to piece together a reversal move. And so in this case what we had was, first of all, if we haven't seen the hammer already, we've certainly had our attention drawn to this bullish MACD crossover, which once again is confirmed by the first histogram bar painting in on the opposite side of the waterline. But we also have here, of course, this hammer, which is a very sharp hammer with a very large price rejection wick to the downside. I tend to regard these myself as deliberate manipulation. Somebody here was marking price down rapidly to try and suck everybody in down to the short side, and as soon as enough people did get sucked in, price was marked aggressively back up again. So a whole bunch of stops. You can be absolutely certain that a whole bunch of stops were triggered here, and a whole bunch of people lost money. The dumb money lost money, but the market movers, they bid price right back up again. And we can see that these two events, without even looking at any other indicators or time frames, these two very strong reversal patterns occurring in conjunction with each other did a very good job presaging or predicting the subsequent strong move up in price. Now, to be complete, what we would do, of course, is draw some trend lines. We had a swing point here and some swing points down here, and we could have given ourselves a Tom DeMark style trend line break and projection, which would have had us moving up somewhere in this neighborhood. But you can see, regardless, that these two reversal patterns really did a good job both terminating this down move and then setting us up for the subsequent up move, which was really strong and protracted. This is probably my favorite application for MACD crossovers, and that is to help outline strategic support and resistance levels. So just to reiterate, if it needs to be mentioned, by support we mean a specific level or perhaps a small zone at which price will go no lower. The market is not interested in lower prices. There's no follow through to the downside, Momentum has waned at that level. It's just simply not going any lower than that level. It's going to go higher or at least sideways for some time. Similarly, resistance, the inverse of that, is a level or a small zone at which prices will go no higher. The market is just not interested in higher prices. Now, if you're working with a concept like Fibonacci, if you're just looking at a Fibonacci grid with price action, and you're plotting in all of the various fib levels such as 23, 38, and so on and so forth, it can be a little tricky or a little bit tedious to try and figure out whether price is going to respect one or more of those levels without something else there, some other signal to help confirm that. So what we're saying here is that the application is to put MACD crossovers in conjunction with what appears to be a strategic support or resistance level, just to make it easier to detect. Again, so just to reiterate some of the more common forms of support and resistance, we have Fibonacci, both the cycle from 0 to 100 and then the extensions beyond that, either below 0 or above 100, such as, for example, 138, 150, 161, and so forth. We have pivots, which are usually used on the daily level, although it is possible to crunch the numbers to get weekly and monthly pivots as well, if you use those. Moving averages, the more common ones, such as 200-period exponential moving average, it's uncanny how often that one line on your chart serves as a strategic support or resistance level once price has left a trend of some kind. And then trend lines themselves, which includes also trend channels. Trend channels just being essentially parallel trend lines, outlining a channel in which price is moving in a sideways or consolidation market of some type. So there are the more common forms of support and resistance. There are others, but those are probably the most popular ones. And let's look now at an example of how a MACD crossover can help us peg those different strategic levels. Okay, here's a structure you may have never seen before. This is what we mean by a trend channel. And I'm going to try to resist the temptation to digress too far here. I'll just explain to you quickly how I've drawn this. When we see price kind of bobbing and weaving with a bit of a slope, whether up or down, what we can do is we can pick two very obvious swing points. In the case of a gently rising market like this, you'll want some swing lows. So in classic Tom DeMark style fashion, we've got a swing low here, and we connect it back to the last swing low over here. This is where I've got these two green arrows just to demark the swing points. Then what we do is we look for an intermediary swing high, and we just copy and paste the trend line, including its exact slope, and just anchor it at the top here. So this red line outlines our anchor point right here, and then these dashed lines are nothing more than splitting the channel into 4 quadrants. So starting with this 50% line right in the middle, and then drawing each half line both on top and below that. So that gives us a trend channel, and you can just see for yourself how even these individual half lines or quarter lines do a pretty good job outlining support and resistance throughout this entire sequence from left to right here. But most importantly, actually, once we've drawn in this trend channel, after we've had a few closes over here, we can see what happens. Price on its own finds its way to the upper trend channel boundary, which is right here. And you can see right here how effective this technique can sometimes be. To the pip, price respects, just touches this trend channel line and falls off. Now, the more important subject is what is MACD doing throughout this phenomenon unfolding. What we can do is just look at the various crossovers from left to right. Of course, at this point on the far left side, we didn't know we were in a trend channel yet. We had no idea, not for some time yet. But in any event, regardless, we had a bullish crossover outlining the left swing point. We had a bearish crossover confirming this intermediary swing high. We had, in fairness, we had a crossover happening here as well, but price action was kind of in this medial zone here, so it wasn't terribly significant. The next most significant crossover occurred in conjunction with the the rightmost swing point happening here. And then again, when price came up and tested the upper trend channel boundary, we had a bearish crossover happening on the far right. So the interpretation of this is that if you've got one of these trend channels drawn in, which gives you some very strong and important strategic support and resistance levels, well, here's price meeting resistance sharply. Touches, falls off, closes below. We're going straight back down here, and that is totally confirmed in spades by this bearish MACD crossover. Now again, I'm not going to get too much into drilling down to multiple time frames to show you a strategy for how you could have entered into this trade. We'll do tons and tons of that sort of analysis later on. But I just wanted, again, to introduce this concept of how MACD crossovers, as you can see from left to right, match up perfectly with these different key turning points in this channel structure. And like I said earlier, in the case of 1, 2, 3, tops or bottoms, on some time frame or other, you will actually see those turning points outlined. Here, we were more fortunate to see that MACD lined up nicely with crossovers at each of the major turning points within the trend channel. Now, this is the Forex Mentor Classic application for MACD crossovers, which is to validate trendline breaks on price, most particularly the Tom DeMark style trendline projection, as well as the more aggressive Joe Chung style trendline break. So I'm not going to actually rehash old material that's being dealt with and explained better than I can do by other people. If you're not a member, you'll want to become a member. Go to the Forex Mentor Library, and there in crystal clear details everything you could possibly want to know about drawing trend lines. But I thought the more useful value-added kind of concept or spin I could put on trendline breaks is in talking about how important it is to establish a proper bias before you even look at drawing trend lines. Because you might want to try this as a homework assignment to prove it to yourself. On any given chart, you can find tons of swing points, and you can connect them in all sorts of different ways, and occasionally price might even break one or more of those trend lines. But you really want to know which way you believe price is going, and then you really want to focus your attention on drawing the kind of trend line that matches up with that bias. So in other words, if you're thinking up and you have every rational expectation in the world for the market to go higher, you really don't want to draw demand style trend lines, that is trend lines with an upslope, and when they're broken that means the market's going down. I mean, it might be useful to do that just to see if you're looking at an actual valid counter trend move flagged by the trend line break. It can be useful to watch it fulfill itself and then turn around and go in the direction you want. But you're just going to run the risk of putting yourself on the wrong side of the market if you're expecting the market to go up and you just see swing points that connect, swing lows, connect them as a demand trend line. Price appears to break that trend line, so you just use that to go down, to go take a short. But if that's not a valid direction for the market, then don't bother drawing that kind of trend line. If you're expecting the market to go up, you ought to be focusing your attention entirely on drawing supply trend lines, because when a supply trend line is broken in an uptrending market, you've got a perfect trigger to get on board with the trend, i.e. up. So MACD crossovers in this regard, it can help you establish that bias you want. So if you're looking at a bearish crossover when MACD is quote-unquote overbought, the type of trend line that fits with that is a demand trend line, because when MACD reverses course as evidenced by a bearish crossover, the type of trend line that matches up with that is a demand trend line, because only a demand trend line break will give you a down price projection. Similarly, you'll want to look for a bullish crossover in oversold territory which often, though not always, is below the water line, to match up with a supply trendline break. Okay, so again, it's the bias or profile of MACD and any kind of crossover unfolding that can help you select the right type of trendline to draw. Okay, so I guess that's the spin that I wanted to put on it. Again, you can draw any type of trendline you want at any time, but if you do it without an established bias, you can very easily find yourself on the wrong side of the market 50% of the time. So let's just show a chart example that illustrates what I'm talking about here. Okay, actually, I realized in the last slide I didn't quite explain it properly in terms of finding trendline breaks aligned with the trend. What we sort of almost suggested was that MACD will give you the correct answer. Well, actually, that's not necessarily the case. You can get validated trendline breaks that are running counter to trend, validated by MACD. The important point is that you read both the trendline break and the MACD crossover event in relation to the trend, if you have a trend. So in the case of this chart, this is the British Pound USD pair. We obviously have a very strong, protracted uptrend in place. And what we're essentially saying then is you have to make a philosophical decision as a trader whether you want to try trading against the trend, counter trend moves, or only want to trade with the trend. If the latter, then what you'll want to do here again is not look for demand trendline breaks in an uptrending market, because it could put you on the wrong side. So I'm going to show you an example. With this clear bearish crossover, we're going to look for nearby swing points. So we've got a swing low here, and in Tom DeMark style fashion, we would connect it back to the last or most recent swing low, which is here. Just to make it easy for myself, I'm going to just draw it from left to right. Okay, and so what you see happening next is, bear with me just a half a sec, is you have now a break of this trend line on this candle, and that appears to be validated by this bearish crossover. So if we were just on the live edge of trading here, we could go ahead, draw our Joe Chung style price projection, and I'll move that right directly under here. And so if I just simplistically saw this trend line break and saw that it was validated, I could draw this trend line projection down here. I could get in short somewhere around this candle, and what I would very quickly find out was that I was on the wrong side of the market, and I got stopped out as the subsequent candle came up and closed well above whatever entry point I got here, drilling down to a lower level time frame for my entry point. The important aspect of this is that the 200 period moving average is moving up very clearly, as is the 100 period moving average, which is this purple line, the guppy slow group of moving averages, the 30 to 60 period EMAs, and we got a little bit of curl down on the fast moving averages, the orange lines here, but price neither penetrated the slower moving averages nor did the fast group of moving averages penetrate or even touch the slower moving averages. So all in all, in a strong uptrend, to draw a demand trendline break just because it was there ran us a very grave risk of being on the wrong side of the market, which is exactly what happened. And there were other examples throughout here. So to be on the right side of the market, if we only wanted to trade with the trend, what we should have then done is expected and waited for a bullish continuation cross in the upwards direction. And that's a little bit of jargon we'll get into in more detail later, but essentially what we see is the continuation cross in the up direction came over here, and we probably couldn't have done a very compelling job drawing a trend line on this time frame, but that's what our lower level time frames are, to find more clearer swing points, and we could have very easily found one on an hourly or lower time frame, drawn this trend line, gotten the break, and this is the area where we wanted to go in, a break of a supply line in an uptrending market. So that just sort of shows how Yeah, even MACD will lie to us. It will validate wrong way facing trendline breaks. But what you want to do is consider the trend, if there is one, and lining yourself up with the crossover events confirming trendline breaks that are on the right side of that trend.